Welcome, everybody, to another Wealthy podcast. Today, we are very, very lucky to have Tim Lawless. Tim is the Executive Research Director of CoreLogic's Asia Pacific Research Division. He manages a team of economic and data specialists across Australia and New Zealand. It doesn't look it, but he brings more than 20 years' experience to the role, regularly providing market commentary on real estate conditions, the interplay between the housing markets, demographic trends, and economic factors. I personally listen to a lot of Tim's commentaries, and anything smart that comes out of my mouth is normally something dumbed down from Tim. So, Tim, thank you very much for joining me today.
G'day, Dom. Thanks for those kind words, mate. I'm sure my age is showing through after 20 years of looking at property trends, but I think you're very generous, mate. Thanks very much.
So, Tim, I really do appreciate you jumping on the show. One of the things that I religiously read is your monthly chart pack. There's a lot of really good data in there for everybody watching, listening. I encourage you to go to CoreLogic's monthly chart pack. It's typically for media or property nerds, but there's a lot of really good data in there. Now, you gave me a little bit of a taste tester that the February numbers are coming out now, and a lot of the data I got was basically from January. I'm especially interested to find out what these numbers look like because, to me, February numbers feel like the first sort of normal month coming out of Christmas, and then January is a bit weird, and February is a truer indication of sales, listings, and activity. So, what are your thoughts on the February numbers?
Yeah, I think that's fair enough as well. We know that through the end of December and most of January, volume tends to be quite low. So seasonally, the market isn't as active, although we don't see a lot of seasonality in our value readings. But interestingly enough, the February numbers were surprising on the upside. So what I mean by that is we've actually seen at the macro level this rate of decline that's generally been easing off since about September last year, seemed to have flattened out over the month. Our national index was only down 0.1%. Remember, back in August, the national index was falling at about 1.6% month on month, and it's been consistently improving or losing momentum since that time. But a 0.1% drop over the month is virtually flat. And maybe even more surprising was to see Sydney actually up a little bit, so up 0.3% on the monthly numbers. And every other capital city generally recording a smaller rate of decline over the month than what we've been seeing over previous months. So it looks like an encouraging sign that the market may be bottoming out, but I'd probably use a little bit of caution in interpreting the figures like that. Maybe this is just the eye of the storm, because we know there is quite a bit of downside risk ahead of us in the sense of higher interest rates, probably persistently low sentiment, and of course, the fixed rate cliff probably adding some complexity to the market as well.
Tim, you said a lot of really interesting things there. The fact that the numbers are only 0.1% is nothing. As you said, it's basically stable, especially if you're talking nationwide. But yeah, it feels like it's good that the bottoming yet has slowed down, but it feels like any number of things can impact property prices. Sentiment is a big one. A few more rate rises could certainly impact the market. And then you also just mentioned the fixed rate cliff. I've spoken a little bit about this. Have you got some thoughts on that fixed rate cliff? And is it as bad as it feels? I mean, the commentary around it is 800,000 borrowers are going to come off 2% and jump to 5%, and the whole market's going to crash. But I feel like it's a bit more nuanced than that.
Yeah, I think it is. And I think there's much bigger risks in the market than the migration of fixed rate mortgages onto a variable rate later this year. The biggest risks, I think, are that interest rates could meet the forecast, which is now becoming a consensus of, say, 4.1%. We'll know that over the coming months, I suppose, but a 4.1% cash rate is well and truly pushing the economy into a contractionary setting. So I'd see that as the biggest risk. With the fixed rate cliff, you're right, yeah, about 800,000 mortgages moving from a fixed rate of probably around the 2% mark up to something that's probably going to be closer to around 6%, maybe even higher than that for investor loans. But even though that sounds, pretty, that's like a tripling in mortgage repayments, we've already seen variable rate holders going through this, and we haven't seen any real material signs of distress emerging in the market. Coming through at the end of last year, each of the lenders were generally reporting record low levels of mortgage arrears, 90-day mortgage arrears at record levels. I think we'd be naive to think that won't rise through this year. Absolutely, people will fall behind on their mortgage repayments, but I think it'll be quite contained as long as labour markets don't implode. We're currently seeing unemployment rate at 3.7%, and bottomed out at 3.4%. Most forecasts have unemployment holding sort of around the 4% mark by the end of the year, maybe the mid-4s through 2024. So I think that's probably the safety net at the moment. But if we did see unemployment rising more materially, then that makes it a lot harder for people to keep on top of their mortgage repayments. So kind of like the other cliffs we've seen through this pandemic, like the fiscal cliff, which was navigated quite well, I don't think the fixed rate cliff is going to be something that is unmanageable. Again, you've also got lenders having a recent track record of being quite flexible with people that move into a distressed situation. So we could see more evidence of, some borrowers moving on to interest-only payments for a little while, or extending their loan terms to make their monthly payments more manageable. I think most lenders will probably be quite proactive in trying to manage their risk.
Tim, we can fall into the habit of talking about Australia as one big market, but you and I both know that interest rate rises and this fixed rate cliff will impact different borrowers with different magnitudes. And I think that those numbers come out when we're looking at the different cities and the states by the way they've performed, and also the different classes of property, different prices of properties. One thing that stood out to me is that Perth, South Australia, and what was the other one? Adelaide have been relatively unaffected. And I'd say that my hypothesis is that they're cheaper mortgages, cheaper properties, lower mortgages. And then that seems to be consistent. If we have a look at the bottom 25% of properties, they've been relatively unaffected by the property market. Certainly seen some declines, but nowhere near as extreme as, say, Sydney, top 25%. Is that a fair assessment? And do you see this carrying?
Yeah, it's a very fair assessment. And I think it's no surprise that those relatively affordable markets like Perth and Adelaide and regional South Australia, regional WA is another good example. Look at Perth is a really good example, actually. You look at Perth's median value, roughly about $560,000. It's the lowest median value of any capital city. It's cheaper to buy a home in Perth than it is in Hobart or Darwin or Adelaide, for that matter. And it's the fourth largest city. So I think that affordability factor is a big part in its resilience. Same with Adelaide, same with some of the regional markets that tend to be more agricultural or mining based in their economic foundations as well, seem to be holding up in value much better. And then at the other end of the extreme, you've got Sydney's upper quartile, which is already down about 17% in value compared to Sydney's lower quartile, which is down about 7% in value. So you're right, we're definitely seeing some more acute weakness around the more expensive housing markets. Arguably, that's where household balance sheets might be more thinly stretched, or where households could be more sensitive to the higher cost of debt. But it's also something we've seen through previous cycles, where that upper quartile, or the more expensive end of the market, tends to lead the cycles, both on the upside as well as the downside. And that's exactly what we're seeing now. And interestingly enough, this recent flattening out, or this loss of momentum in the downturn, is emanating out of that upper quartile, interestingly enough. So maybe this is a good barometer of a bit of an inflection point in the market, that upper quartile has already worn the bulk of the downturn, and maybe starting to be the first sign of a stabilization, although still qualifying that with some uncertainty ahead.
So to bring it back down to mum and dad investors and people looking to buy their own home, would you then say that there are, I think, two opportunities that come out of that for me? one, if you're looking to buy a discount, if you're looking to sort of trade in property, buy something that has bottomed out, you wouldn't want to be looking at the more expensive part of the market. That's where you're getting the best kind of vendor discounting. And then two, if you're looking to be a more modest investor, the more robust part of the economy or more robust part of the property market would be to go for the affordability part, where the swings aren't as huge, but you're certainly getting a more stable shift or movement in the swings of the property market.
Yeah, I think that's a pretty good rule of thumb. Buying into a more expensive market tends to come along with underlying scarcity value in the sense that more expensive markets tend to have this inherent scarcity value. It's harder to bring in more supply, and generally demand around some of your blue chip markets is quite resilient. So over the long term, you find that even though those markets do tend to be a little bit more volatile, higher growth through the upswing, larger decline through the downturn, when you wash all that out, they tend to show a higher growth profile than more affordable markets. When you get into more affordable markets, another rule of thumb seems to be that even though your prospects for capital gains may not be as high, your entry point is a lot lower. So maybe your risk profile isn't quite as substantial. And also rental yields tend to be higher as well across that sort of middle to lower end of the market, mostly because you're looking at a smaller or a lower buy-in price against a rental rate coming through that's high relative to your purchase price. So it depends on what sort of investor you are, I suppose. If you're driven by yield or opportunities for cash flow, you might be targeting that medium or to lower end of the market. If you're looking for long-term capital gains, you might be targeting something a little bit more expensive.
Really good insights. Thank you, Tim. Now, I was going to talk to you a little bit about sales volumes and listings, just because I feel, one, the data has been telling us that listing sales volumes have come back about 20% on the previous year, and then listings are down 20 odd percent on the 5-year average. Do you see those numbers starting to increase over time? Maybe as mortgage pressure starts to increase, or maybe when the economy starts to stable out, do you see the listing volumes coming back and there being more buying opportunities in the market?
You'd have to think that there's going to be a time where vendors, or prospective vendors at least, are going to become more active, either through necessity or because confidence improves and the market's looking a little bit better. At the moment, to those numbers, I'll talk nationally, so kind of macro numbers here. The number of listings across Australia is tracking about 20% below the 5-year average. So remarkably low. In fact, the flow of new listings for this time of the year, it's hard to think of a time where they've been lower. Transactional activity, so the number of home sales, is about 11% below the 5-year average. So we've definitely seen activity coming down along with less supply, but it looks like supply has fallen more than what demand has. Hence, I think that very low, the very small number of listings in the market is probably one of the features that's helping to keep a floor under prices to some extent. Now, talking about going forward, there is a risk that we'll start to see more new listings coming into the market, either based on necessity, people that are more motivated to sell or have to sell because they're struggling with serviceability. I think that won't be significant, but you have to expect there's going to be more people that simply can't fathom another, say, 50 basis points of rate hikes. Whether that's accompanied by a lift in demand, I doubt it until interest rates start to come down. So definitely that is one of the risks over the months ahead. I think we need to be watching the flow of new listings quite closely, because any sign of a rise in the flow of stock coming on the marketplace that isn't accompanied by a lift in demand, arguably we would be placing further downwards pressure on prices.
Okay. And I mean, that's really interesting. We started to now get into a little bit of predictions, which is what people like to see, find out what the crystal ball says. So I was going to ask you, very generally top level, some sort of 1, 2, and 10-year predictions. I want to talk about the near and the long term. Now, you like to pay attention to demographics and people movements and what's happening from a not just the property data, but what's happening from the economy and nationally. Something that's standing out to me that may feel like an opportunity or perhaps even put upward pressure on property prices are a few things. One, it's the people data. I've noticed that we're near pre-pandemic migration levels. Tourism is certainly coming back. Students are coming back. China has put that release out saying that all the students have to come back into Australia. Do you see this having an impact on the property market, and where do you see it having the most impact for those investors looking to jump on top of that chain?
Yeah, demographics obviously are really important for housing trends, especially the demand side of the equation. So think about some of the changes in the permanent migration intake for Australia, an extra 35,000 people a year over the next 2 years. Is obviously going to result in more people coming into the country, especially when you consider that permanent migrants tend to have, I suppose, more of a focus on eventually buying a property. So ultimately, increases in overseas migration tend to flow immediately and directly into rental demand before they flow into purchasing demand. And then gradually you start to see more people moving into a purchasing situation. So I think over the medium term, higher migration is very important. But over the short term, it's probably more impactful on rental demand. And we're already, as you know, seeing a significant imbalance between rental supply and rental demand. Vacancy rates around 1%, with the migration intake, foreign students in particular, increasing so sharply, it's likely vacancy rates will remain really, really low, and we'll continue to see upwards pressure on rents. Maybe not at the same extent we've seen over the past couple of years, simply because renters are approaching a ceiling on what they're able or willing to pay. So no doubt in the wings, there's also going to be some adjustment in our own demographics here as a country, where if you remember during the pandemic, households became smaller. A lot of group households split up to become single person or couples, and share households were utilizing the second or third bedroom as a home office. I think already that's starting to change, and households will become larger. That will offset demand a little bit, but I think more than compensated by the rise in migration, where net overseas migration will be adding to demand over the medium term.
That's a comprehensive answer, so thank you for that. It's interesting to me because I'm watching a trend, and I'm looking at this from, as you just said, a short, medium, and long-term trends. One thing that's piping my interest at the moment is certainly over the short term, we've got a lot of people coming into the country from those different groups that we've just spoken about. The second thing that I'm noticing is that there seems to be record low levels of supply. The HIA put out some data saying that brand new starts have almost halved. There's some new data that just came out, I think, in the Fin Review today from Keck Kramer, that there's a severe undersupply. I think it's 50 to 70% of approvals are coming back over the next couple of years, specifically for apartments. Do you think that this next, say, run of activity in the market may come from investors looking at and saying, well, the yields are starting to climb back up again, and here are the opportunities? Or, what do you take from the picture that I just put down, Drew?
Yeah, I think there's a few nuances about supply. So when the HIA reports that the number of new home sales has halved, it's generally from really high levels. After the home builder grant caused a real surge in low density detached home building, that's now winding down. So there was a pull forward of demand, a lot of building activity that's now moving through to settlement. It's not surprising to see it coming down so sharply. But more broadly than that, just look at the approvals data. So if you think about the development cycle, it starts with a development application, then an approval, and then a commencement, and then ultimately a completion. Approvals, particularly for the medium to high density sector, are still trending lower, and they've been below the decade average since about 2018. So if there's any segment of the market that's, I think, either in undersupply or will be in undersupply in the coming years, it's probably that medium to high density sector, especially in markets like Sydney and Melbourne, Brisbane as well, where there simply hasn't been much of a supply response. over recent years for a whole bunch of reasons, like things like construction costs, finding labor. Lenders are a little bit more cautious lending into the off the plan space for borrowers as well. So there's a whole bunch of reasons why, but regardless, I'm pretty sure that high density sector or medium to high density sector will be in a pretty bad supply situation, undersupply situation over the coming years, especially in the context of the high migration and the really tight rental markets as well. So yeah, I think that's probably where some opportunities will be if you're looking for capital gain. I normally suggest looking at houses because that underlying land value appreciates so much. But over the coming years, you'd have to expect there's some good opportunities in the medium to high density sector as well.
Yeah. I think that's a really good breakdown. I can absolutely see that happening. One thing that's also grabbed my attention, Tim, I know that we're running out of time. You're a busy man and back-to-back meetings, so I'll be brief. I've got two more questions. The first one is, and you'll be able to verify if this is true or not. Some of the data coming out of, I think it's population.com, which is coming from government data. Some of the predictions are that Melbourne will be a bigger city than Sydney by, I think, 2030, or those numbers are hard to skew, but basically the vast majority of migrants have been going to Sydney and Melbourne. Melbourne's typically catching a little bit more than Sydney, and they anticipate that Melbourne will be a bigger city than Sydney in the next 7 to 10 years. Do you anticipate with those numbers changing in that direction that the Melbourne property prices will catch up to Sydney, or will there always be a disparity between the prices of Sydney and Melbourne?
There's always going to be some rebalancing, that's for sure. And I'll talk about Melbourne and Brisbane as a really good example of that in a moment. But think about the recent growth cycle where we saw Sydney housing values rose about, nearly 30% through the upswing. Melbourne was up about 17%. So the pricing gap, or the value gap between Sydney and Melbourne has widened massively over the past couple of years. So I think that puts Melbourne in a pretty competitive, for want of a better word, competitive affordability position relative to Sydney. That in itself should attract more migrants, particularly interstate and internal migrants. We know Melbourne's done it pretty tough through COVID. A lot of people left Melbourne, went to regional Victoria or other states. We can probably see interstate migration going back into positive territory quite quickly because of the affordability advantage and hopefully lockdowns being a thing of the past. If you look at the other competitor, for want of a better word, to Melbourne being Brisbane, Brisbane started COVID about 30% below Melbourne in terms of the typical median value of a dwelling. It's now about 6%. So in that sense, Brisbane's lost some of its advantage, at least from an affordable perspective. So yeah, I think Melbourne will probably rebalance. I'd find it pretty hard to see Melbourne getting a price point that's higher than Sydney. Maybe that's just some bias on my behalf. There was an example in the past. Think about Perth back in 2006. Perth prices were actually higher than Sydney's based on the median values. They're now the cheapest of any capital city in the country, by the way. So not that that sort of out of balance will last. So watch this space, but yeah, you'd have to think that Melbourne values will become a lot closer to Sydney's as population growth ramps up.
Thank you. And that's interesting. I didn't realize that the Brisbane property prices had caught up so much to Melbourne, though thinking about it, it makes sense. I think the last time I saw the numbers, it was the big winner out of COVID was Brisbane. They received something like 40,000 interstate migrants, for want of a better word, and Melbourne was the biggest loser from all the states. So it's like everyone left Melbourne, went to Brisbane, and property prices then caught up to Melbourne. So that makes sense to me.
Yeah, I'm a Southeast Queenslander myself, and there's a lot of Victorian registration plates around.
Tim, last question. This is I've got a book coming out, and it's a testament to that book. And the book is You Won't Fuck It Up, Buying Property is Easier Than You Think. And the question is, what would you recommend, or what's your advice for brand new investors and homeowners entering the market so that they don't fuck up their next purchase?
Well, congratulations. Great to see the book coming out. It's quite a catchy title, that's for sure. Advice to say somebody getting to the marketplace is A lot of people try to time the market. I would say forget about doing that. Buy based on your own timeline and your own budgets, your own life cycle. Try to time the market. It's a bit of a mug's game, and it's virtually impossible to get it right. It's a matter of luck. The second thing would be don't overextend yourself. Always allow a bit of wiggle room for a rainy day or a change in your own circumstances. And maybe the final thing would be, I've always found that investing to buy a property that you wouldn't mind living in yourself has always been a good rule of thumb. If you buy something that you personally wouldn't want to live in, then chances are you might find it hard to find a renter, or it might have a low resale value. So look for properties that at least have a certain level of livability.
That's really good advice. So don't try and time the market. Get in when it makes sense for you. Buy beneath your means. So don't overextend yourself, and make sure you've got that buffer and you don't have to overextend yourself. And buy something that you can understand, or something that has that livability there. Because if you don't see yourself living in it, then chances are that another tenant is not going to want to live in it. Now, that doesn't necessarily mean that it's appropriate for everyone. I have a son now, and that doesn't mean that right now I wouldn't live in a 2-bedroom apartment, but I can see what you're saying. Look at something that, makes sense, has a beautiful view, or something that you can understand why a tenant will want to live in there.
It has a broad appeal. Yeah, absolutely. I think you summed up my comment much more eloquently than what I could have.
Thank you, Tim. I really appreciate your time today. Your market commentary is excellent. For everyone watching again, I encourage you to subscribe to the YouTube channel, pay attention to Tim's commentary, the monthly chart report coming out, or it should be out in the next day or two. And Tim, have a great day and happy investing to everybody out there.
Really enjoyed being part of the video, and we'll see you next time.
Thank you.